So I was just in LA, and I drove for the first time through
Thank you.
drove through Malibu, like on the PCH, and on the way to LAX. So you got to go through. I was in like the Thousand Oaks area, Westlake Village. So you had to drive through the canyon down Malibu, and I hadn't seen it yet because this happened when? January? Okay. I could not believe the destruction. Like 1,000, it seemed like 1,000 lots were just empty.
I drove it for my first time myself this last weekend.
Oh, okay.
Because I have such PTSD.
We might have been on the same road at the same time.
Going the opposite directions. I was going north, for a wedding. But I went through the Palisades, and I've just not been able to bring myself to drive through.
I have never seen anything like this. I mean,
dozens of friends have lost their homes.
Yeah, it's hard to describe, but like the lots where the homes used to be are separated by like fences or something they used to be. So it's just lot after lot, and I think it's thousands of them that were on the beach where these things were burned down to the foundation. Like you just see like concrete and wreckage, and it feels like it goes on for 10 miles. I don't know.
It's from Santa Monica all the way up to Malibu. So 10 miles is exactly right.
I would guess, and I don't know this for sure, that's got to be in dollar value the biggest destruction of like individual people's properties that we've ever seen.
100%.
Like I know Maui was really bad, and I know California's had wildfires.
I don't know how to inflation adjust Pompeii, but
yeah, I mean, no, this it reminded me of the Chicago fire. Not that I was around for it, but like the things that you read about it, where a quarter of the city burned down. That's what this looked like to me, and I was just blown away by it.
Yeah, we could not get to our home we were told to evacuate. We were out for 10 days. I was able to sneak back in, over the first 5 days. Then the National Guard came in and I couldn't get back in. But it's a great advertisement actually for Amazon, because I got back and somehow packages were at my front door.
Oh my God. I mean, they're delivering in an apocalypse.
Yeah, I don't know how.
So my brother lives in Calabasas, and they were evacuated twice from their neighborhood. And thank God nothing happened. But like twice they had to go to the in-laws and just, you watch the Ring camera and
so they were up in the hills in Calabasas. Yeah, it's horrifying. I grew up out there. That's my old stomping ground.
That's a really cool part of the country that I hadn't spent a lot of time, but I was there for a couple of days this past weekend. And somebody told me it's like a coal town. It's like a company town. Like all the wealth originally in that area is from Amgen. Is that true?
Well, not originally, no. Amgen wasn't.
I mean, like
wasn't a thought, but after Amgen became
the mansions, the McMansions.
But later on, Amgen was not a large enough employer to develop Calabasas.
Okay,
Steve, you remember where this picture was taken?
Oh God, the GAT photographer promised me that he was only going to take that picture with sunglasses, because I wouldn't do it. And I said, I'll look like a. Can I say asshole in this program?
Yeah.
Okay, I'm 35 years old and the cover of Money Magazine. The last thing you want to do is, knowing the ebbs and flows of the markets, and you're not always going to be, on the hit parade. And the last thing I want is to have a photograph of myself with sunglasses. But of course,
are there palm trees too?
Yes.
It's like the kiss of death.
It's Beverly Hills. Beverly Hills.
You look like Aaron Eckhart in that picture.
No, take it down. We'll put it up later in the show.
Can you not?
No, we're gonna. I want to know. I want to know all about that
show. I'll be a sponsor just so you don't put that up.
Oh, it's going up. It's definitely going up. Would you consider me to be a wife guy?
I don't know what that means. A wife guy?
Does anybody here know what that means?
A wife guy? No.
Nobody knows what that is?
Without knowing what you mean, no.
Somebody told me I'm a wife guy. One of my cousins told me this. I'm like, what do you mean? He's like, I don't know, like, you're always doing stuff with your wife. I'm like, well, don't most of us? He's like, no, you do like guy stuff, but you bring your wife. I don't know. That's not true. Like I do that?
That's not true. I mean, you have brought sprinkles to stuff, but
so is it sort of true?
You're not a wife guy, but I wouldn't.
Like a wife.
You're looking at me like I have a point of view here. I just met you guys.
Are you a wife guy? Would you say you're a wife guy?
If my wife listens to the podcast, I'm 100% a wife guy.
No, it doesn't mean if you're not a wife guy, you don't like your wife. It's more like there are guys that will bring their wives to stuff.
Not me. I'm absolutely
not a wife guy.
Not a wife guy.
But I am.
I love my wife, but not in that
You
context.
love her enough not to subject you to the version of yourself when you're with your boys.
That's exactly right.
Okay, I always thought that of myself too, but I guess I'm not.
No, you are not.
I am not. Nah. All right. I'm relieved now. I don't know. So it's like you're kind of a wife guy. I really am.
That's an interesting thing to say, somebody.
Yeah, it's a weird thing.
Yeah.
So
Just making up terms.
but you have friends that you know for sure are wife guys.
Hate wife guys.
All right.
Let's go, John.
This is called easing into the financial side of the discussion.
Before I insult any of the wife guys in the audience, we love you. We love your wife. We support wives on this show.
Today's show is sponsored by Public. Public is the investing platform for those who take it seriously. You can build a multi-asset portfolio of stocks, bonds, options, crypto, and more. You can also access industry-leading yields like the 3.8% APY you can earn on your cash with no fees or minimums.
But what sets Public apart? AI isn't just a feature, it's woven into the entire experience. From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. Plus, for a limited time, you can earn a 1% match on all IRA deposits, IRA transfers, and 401k rollovers.
Fund your account in 5 minutes or less. Find out more at public.com/compound.
Paid for by Public Investing. Full disclosures in podcast description.
Oh, of course we do.
All right. All right. Thank you, John. Ladies and gentlemen, welcome to the Compound and Friends, the best investing podcast in the world. John is here. Nicole Duncan is here. Our friend Steve Schaefer in the house. Steve, you sit in on a lot of these, bro. We should have like a dedicated chair for you. You like being here? You into it? All right. All right. Thanks, Steve. We have a very special guest. I called him a legend when he walked in today. I've read his stuff over the years. I've heard his name over and over again. He is highly specifically, I would say, revered by a certain component of the investment market. My first exposure to research is through Meb Faber. Meb always shouts your stuff out on the Idea Farm. Do you know that?
Sure.
Okay.
I didn't know we always said it, but I like that a lot.
He's a big fan of yours too, and so am I. Steve Romick joined the FPA in 1996. He serves on FPA's management committee and as a co-portfolio manager for FPA's flagship global asset allocation fund, FPA Crescent. You started that fund 3 decades ago, Steve. I don't know if you know that.
I do know that.
FPA is a Los Angeles-based institutional money management firm practicing a disciplined approach to value investing with approximately $30 billion across multiple strategies. He is a multi-year award winner in the mutual fund community and someone who has earned tons of respect over the last few decades. We're so excited to have you here. Thank you for joining us.
Thanks for having me.
Did Steve make you come?
He did.
All right.
I really tried to get out of it.
He did the right thing. We're going to have so much fun today, I promise. I promise.
Steve, you were a young man when you had that when you got that responsibility.
I think he just called me old.
No, it would have been funny if you
holy shit.
ended the sentence. You were a young man.
You were young once.
I was young once.
But you had a lot of responsibility as a relatively young man.
I did.
Like, that's impressive.
I started working for a hedge fund back in the mid-'80s, and I realized there was kind of a gap in the market. There wasn't a public fund that really kind of served my interest. And so I said, why don't I just create one? And so I did.
What was the gap?
Well, the Go Anywhere Fund, everybody, with a lot of there weren't as many investment partnerships then as there are now, and there's fewer now than there were 10 years ago, I would guess. But back then, there was, you were really siloed. You were a large cap investor, you were a small cap investor, you were a U.S. investor or national, you were debt or equity, and if you were debt, you were high yield, you were high grade. And so there really wasn't anybody that could kind of look across the landscape in the capital structure to kind of create that, look at a breadth of opportunity. And so why don't I just create that?
You were 60-40 before 60-40 was a thing.
It's a really great point. Like a lot of the most well-known investors or even asset management firms, probably not recently, but over the long term or throughout the history, you became known as a bond shop or a stock shop, or these are growth guys, these are value guys. The ability to do what you thought makes sense in that moment was probably where the big gap was.
Yeah.
Okay.
I mean, at moments in time, we will look like other people and we'll own a lot of stocks that other people might own at a point in time because the crowd isn't always wrong, but often it's not always right. And not to be able to have that flexibility to do something different can be problematic.
What's the hardest part of your job, the stock selection itself or choosing the allocation levels for the different asset classes that can be in your fund?
It's the security selection. I'm going to broaden it out because it's not stock, whether it's stock or bonds. It's a security selection because the allocation is a byproduct of what we're finding as opportunity. We don't make an allocation decision. Oh, we want to be 30% in cash, 20% in cash.
Oh, okay.
If we see things that are attractive, offer good risk rewards where we can protect our capital on the downside and then see good optionality on the upside, we're going to go and put capital regardless of the environment.
So if you see 50 stocks that you just absolutely have to have because you recognize there's an opportunity there, you don't have a problem taking down your bond exposure because you're not up against a wall of, hey, you're supposed to be 20%, this many bonds, 30% stock. Like you
taking down our cash exposure because we don't actually have much bond exposure at all today. We can dive into that if you'd like in a little bit. But it's cash. Cash becomes a residual byproduct of our investment process. So we'll pull down from that cash repository when we see lots to do, and when we don't, we cash builds.
I want to start by quoting you. Is that okay?
Sure. Nobody else does.
All right. You said earlier this year, in the midst of the tariff tantrum. I don't know. Do we have a name for what went on in March?
Tariff tantrum.
Tariff tantrum. Okay. You said this. A decade ago, I gave a speech to the CFA Society in Chicago and said the one thing you shouldn't be surprised by is surprises. Nothing's ever certain. At the end of the year, more than 40% of investors thought there was less than a 10% probability of a stock market crash. During the depths of COVID in 2020, less than 15% of investors thought there was a less than 10% probability of a stock market crash. Investing, like life, is eminently unpredictable. I anticipated there would be fires here. There were videos of Richard Nixon in the 1950s hosing down his roof. I had fire hoses on my property, a pump to take water out of the pool, but even the best laid plans. So it sounds like you are, end quote. So it sounds like you are risk first or risk management first, and then seeking opportunity secondarily. And I guess that explains why you've been able to survive for 30 years, basically doing the same thing that you've been doing. A lot of people haven't had that longevity. Do you think it's
evolved? It's evolved along the way. Yes, I certainly believe that risk first has been paramount for what we do, but the longevity isn't just tied to that. It's also, there's a lot of my brethren over the years, value investors who are no longer in business, sadly, because they were risk, protection first, downside management, but they forgot about the upside. Yeah. So we're very mindful of the upside too, and making sure that we, are always seeking the opportunities. There's generally something to do. And I'll credit my partner, Mark Landecker, more than anybody else to really pushing me in that direction.
I want to put up a chart of the total return of your fund. And I know there are compliance rules, so we're not going to have any forward-looking statements here. But I mean, this is one of the most impressive things that I've seen outside of looking at like just an index fund or something. I mean, you have really done the job for the people that have entrusted you with money, and you've done it for a really long time. Do you ever look at this and say to yourself, like, I did it? Like, do you feel that sense of accomplishment by now? Do you give yourself that at least?
Generally not. I feel a little bit like a movie producer. You're only as good as your last hit movie.
I know, but there's a lot of hit movies in here.
Yeah, I mean, there's been good moments. There's also some drawdowns in there you see too. But fortunately, our drawdowns have been a lot less than the market. We've had these market drawdowns. But no, I don't really. We don't rest on our laurels. We're always looking forward. And I think that if I were to sit back and think about inarguably we've done a good job historically. But what keeps me getting up every day is knowing that I need to keep doing that.
Yeah. Can I show you a picture?
No.
John, if you would. So, all right, but let's talk about this. First of all, the timing of this is unbelievable. This is Money Magazine, the 1998 Ultimate Guide to Mutual Funds. So I'm guessing this came out in early 98, right? Or late 97?
This is your Madden cover. It was all downhill from here.
Well, so you're on the cover. You're sitting on, is that a limousine? What is that? Benz?
No, it's just a used BMW.
All right, stop. Used. Yeah,
it was. I swear to God.
Used for the photo shoot.
No way.
All right, but you were one of the 5 fast ranking stars and probably the most handsome one, so they put you on the cover. This is you at 34 years old. And all right, you've already expressed to us you didn't want to be in the picture. We understand that. But that's kind of cool when you're in your 30s. Like that level of recognition, people said, this guy knows what's going on. This guy's good at what he does. You have to admit that's kind of cool.
It was cool at the time, but the sunglass thing really was not cool.
Okay. I get it. Well, I think it looks cool today. Look at the subheadings, though. Beat the year 2000 bug is on the top, and then cash in on falling rates. From this point forward, we basically had 24 months to get out, right? Is that the way you'd think about it?
Yeah, it's like, I think more important point is they put me in the cover of Money magazine only to see my relative performance decline, precipitously.
Well, you were in the wrong stocks for that 2-year period.
For that 2-year period, 100%. We were behind the market by 40 some odd percentage points, give or take, over the 2 years. So to back up
for people that weren't around then, if you didn't own internet stocks, and in 98, that was Amazon, eBay, Yahoo, AOL, Netscape. Like if you were not in that trade, you might as well have not existed.
Sun Microsystems and the list goes on.
Sun Micro,
look at
EMC.
This. You look like Berkshire.
Yeah. I was going to say that looks eerily similar to, the Warren Buffett cover. Warren doesn't know what he's doing. Like that was
Barron. That was Barron's in that era. I really think the reason we had any money left in the fund was because people either A, felt sorry for me, or B, they forgot they had money with me.
So you lost 85% of your assets.
Yeah.
There's a famous quote. You probably know the guy's name, the French guy that ran First Eagle Global.
Jean-Marie Eviard.
Okay. Legend, another legend. Jean-Marie Eviard said, I would rather lose half my clients than half my clients' money. And that became sort of a rallying cry for value investors over the years since, like, I'm not going to chase this. I don't care if you redeem me. It's just, this is not the way I invest.
It ended up being the right decision because we made money in 2000 when the market was down. In fact, if you look over the 5 years, 98 to 2002, if you were to carry that chart further.
Chart 5, John.
We actually, earned it all back and then some, and we ended up well ahead of the market. So here we start off the same place you see in that chart.
So that's
on the left in 98.
That's you on the hood of the used BMW with the sunglasses on it, 10,000.
Perfect timing.
You turned that into $10,000 into $14,000.
Did you feel bitter? Like, did you call the people that fired you and said, "Ha"?
No, I didn't, because that doesn't do any good. But
Josh would have.
I did.
100%.
I did have one client, will remain nameless, institutional, separately managed account, who fired me in that period. And 12 years later, 11 years later, they came back and became a client again. But it was a committee. And I don't think they remembered they had money with me 11 years earlier. I didn't remind them of that fact.
Okay. So what did you own all right, so that it's an impossible environment to not lose your head, at least temporarily, because there literally are stocks like Dell Computer that are going up 5% a day every day for 6 months. I was there. I remember it vividly. Thankfully, I was managing $10, so nobody cared what I thought. And I had no context for what I was witnessing. You were a little bit older than me, so you kind of knew what was going on. What did you own in order to stay out of that fray? And were there people in your firm that were like, Steve, what are you doing? We got to get long. We got to be in this trade.
Well, first, let's start with the firm. I'm very fortunate to have always had great partners at First Pacific Advisor. And, at the time—
That's what the FPA stands for.
Thanks.
All right.
Bob Rodriguez was leading the charge of the firm then, and he was operating similarly. So no pushback from the firm at all. Pushback from clients. How do you not own Microsoft when it's growing like it is, and both in its earnings and its stock price? It's a one-decision stock.
Did you never own those names?
I did. No, we bought Microsoft. To jump forward for a minute, we bought Microsoft in 2009-10. I guess it was 2010.
But in the late 90s, did you?
No, didn't own one.
Wow.
Didn't own one. And so returns are driven not just by what you own, but what you don't own. So if you're able to avoid some of these big disasters, you can see them coming. You could see the disaster coming. Didn't know when, but you knew that it didn't make any sense. And so we were able to avoid all of it just because we felt the right thing to do was to, A, protect capital, B, these valuations didn't make any sense, C, there were lots of companies offering terrific opportunities at the time, companies that were, relatively mundane businesses, that where insiders were buying a lot of stock like Pinkertons, which has since got sold, the securities services firm, or IHOP, the pancake house.
Right. So you were still sticking to your discipline, looking for lower valuations where there was more potential upside if things went well. And everyone else was thinking the internet is going to change the world in ways that you cannot imagine. And if you're not in these stocks, you're missing out on the greatest opportunity in history. That crowd was right. They just owned the wrong stocks and they owned them at the wrong price.
Price matters.
Price matters. So that's the big takeaway. It's not that Microsoft didn't change the world multiple times. It's that paying 70 times earnings, they could change the world and you could still lose money as an investor.
And a lot of it was, I would call it being dead right. Yes, the internet was a thing, as we well know. It is a thing. And at the time, there wasn't the infrastructure around it to support the businesses we thought they might be able to do in the future. So, for example, eToys.
Yeah.
eToys market cap, to speak after it came public, exceeded the entire toy market.
Yeah, it made sense at the time.
I mean, but meanwhile, there was no ability to deliver these piece goods, these toys and small tickets to people in any kind of economic fashion.
Right.
There wasn't the distribution system that exists, to the home today, or the distribution centers to kind of do it and break pack, these different things and sell something and deliver it, at $12 average ticket.
So there were two types of disasters looming. One of them was companies that just made absolutely no economic sense for the reason that you just cited. Those are the Pets.com and the eToys. And I don't know, were there 500 of them ish? Something like that?
I don't know the number.
They came public as fast as they could do the paperwork. There was like literally no limit. Webvan, Peapod, it's just like this endless list. That's one type of disaster. The other type of disaster is paying 120 times earnings for Cisco. Cisco's fine, still exists, still a dominant company. But you had to wait 20 years to get back to those previous peaks. So I guess avoiding both types of disasters, it's not equally difficult.
Yeah, avoiding again, comes back to that statement, price matters. So you're saying both avoid the binary, the companies that are going to zero, and avoid the companies that are good businesses, but the valuation doesn't justify, its prospective earnings stream. Going back to the example, of Microsoft's earnings over the next decade, give or take, were up about 18%, compounded between 2000 and 2009. It ended 2009, lower than where it started the decade.
With growing earnings.
With 18% earnings growth.
Yeah, that's how expensive that stock was coming into the decade.
So,
and Ballmer lost his job over it.
No, he didn't lose his job.
People were like,
he had it for years after that.
Yeah.
And we bought this stock because we bought it at a point in time where people were really fearful about, form factors and people are going to be using this iPad that sits in front of me and not use PCs. People are going to not use Microsoft Word. They're going to use Google Docs. They're not going to use DOS. They're only going to use iOS, based products. I mean, a lot of that was there. And since then, they've obviously, found a way to be, moderately successful.
People learn, lean a lot on history and prior market cycles. And I think that the dot-com bubble and bust was very destructive, not just for all of the money that was lost at the time, but a whole generation of investors who thought that history was going to rhyme. So one of the quotes from that period, in retrospect, that a lot of people look at is from, and you've highlighted this, is from the CEO of Sun Microsystems. So he said, at 10 times revenue, to give you a 10-year payback, I have to pay you 100% of my revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard for 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? And so we know how that ended. And I think a lot of people have been making the analog for the last 10 years, since 2015, when we coined FANG, about that period of time. You guys have somehow managed, because you lived through it and you made a lot of money through it, but you have somehow managed to more or less keep pace for the last 3 and 5 years, despite having a cash allocation, a bond allocation. It's almost like a miraculous.
And a value discipline.
Yeah, like how did you survive? Because nobody else did.
Well, I'm not going to luck does play a role. Sometimes you just get it right, for periods of time. And certainly that's part of it. But, look, being thoughtful about what businesses are going to be better businesses in 5 to 10 years, or at least as good, if not better. And that is to say those businesses that are going to throw off more cash flow than they throw off today. And what are you paying for that cash flow in the future today? So if you just look at that and think about it like a bond, if you just were to invert every investment you were to make from a PE basis and look at it on an earnings yield basis, and better yet, look at it on a pre-tax free cash flow basis. Take the company's cash flow before taxes and before interest expense, and look at it on an unlevered basis. That's the numerator, and divide that by your denominator, your enterprise value, and kind of compare it to a bond and look and see how much you're going to get for that, like a Treasury inflation protected note. Well, that'll give you some kind of growth in the future. So what do you want to pay for that growth is what we always come back to. And some things just get to be too expensive and so we back away. So we tend to lean into businesses when people don't like them. We still think that there's a few good puffs left in those cigars, if not more. We make a lot of money if they really end up being something better. So Microsoft's a good example of that. We bought Google in 2011 when people were really, really quite fearful of the global economic landscape. We bought Meta, which was Facebook at the time, during the Cambridge Analytica scandal. Streaming was dead during COVID, so Netflix traded down. So we bought Netflix, which we don't own in Crescent anymore. But when you can find these businesses you think are going to be better in 5 and 10 years, and you have a variant view as to that perspective, there is often money to be made.
Would you rather own a company that you think the prospects are going to be better, even if it were more expensive, versus a company that's already expensive, but you agree the business is going to be great and the market is right? Like, what's more important to you, the outlook for the company or the valuation?
They're connected.
It's a balance.
It also, I'm not going to pay 100 times earnings for a company, that it doesn't make any sense.
Here's what I'm asking. If I gave you NVIDIA's last 12 quarters and I came to you 3 years ago and I said, here's the next 12 quarters, you have to pay 50 times earnings for this company. You would, though, right?
Sure, if you know the company's going to grow earnings at 50%.
None of us do. But,
right. So it's all a function of your conviction of what the growth rate of the earnings stream is going to be prospectively.
Yeah.
The greater the conviction, the more likely we're willing to pay up for something.
I asked you that question because I think unfairly, a lot of people think of value investing as this PE is lower than that PE, therefore press the buy button on this one. And I did see some of that with like Intel versus NVIDIA a few years ago.
AMD, definitely.
Yeah, so there does exist that mentality, but that's not actual value investing. That's just looking at publicly available numbers and being as unthoughtful as possible about it. There's a lot more that goes into figuring out, is this truly a great business and worthy of a premium multiple?
But you bring up an important point, because value investing historically was really about the protection of the balance sheet. As it was historically practiced and written about, starting with Graham and Dodd. It was about the protection of the balance sheet, buying a company below book value. Better yet, buying it below its working capital, but its net working capital.
Good luck doing that now.
Yeah, exactly. Right. And that's the way we started out and really thought about, protecting capital. But then we realized over time that so many of those businesses were businesses that were more likely to be disintermediated and disrupted by technological innovation, better competition, et cetera. So we really sat back and said, all right, we have to really consider what the value of the business, what the enterprise is, how good is that business, and own these better businesses and pay a good price. So the protection is still a B. It's just not the balance sheet, it's the business. And so there's more volatility that comes with that. Valuing a piece of real estate, doesn't move around, as much as valuing a business.
If I had a stock that I was very certain was going to deliver a minimum of 20% earnings growth next year, and it was currently selling at 16 times earnings because there was some idea out there in the market that it was about to be disrupted by automation, would that be the type of stock that you would say, all right, we got to take a second look at this?
No, this can be disrupted. We wouldn't look at it at all.
But you don't know that it's going to be disrupted. The same way.
I thought your premise was that it would be
I can't
disrupted.
tell you that it will. I could tell you the reason it's 16 times earnings in a 22 times earnings market is because that's the concern around it.
100%. That's the kind of business we'll look at.
So that's Uber. That's $200 billion market, $250 billion market cap, 23% earnings growth expected for next year. so cheap they're buying back shares, which is not a thing that you would normally see a company like this doing, but how could they resist? And I look at something like that and I say, okay, I believe in automation, but then I also believe this company's going to figure out their own automated taxis. How hard could that be? There's going to be millions of automated cars.
Well, they're going to have to figure out by licensing somebody
100%.
else's technology.
Yeah, they won't build it.
Or they get acquired. Maybe Google ends up acquiring them. Okay. I mean, that's not a call. Just to be really clear.
Understood.
I'm just saying that anything's possible.
Well, I guess my point is, even in this moment with the S&P selling at a high multiple relative to history, there are lots of those types of companies right now. Adobe's another great example.
Salesforce.
There are businesses right now that people are very convinced AI/automation is going to be the end of those companies' franchises.
In some cases, it'll be true, to your point. In some cases, it won't. So it's our job to sit back and understand whether or not how likely it is to be true. And by the way, just because it will be true, if a company can generate a ton of cash flow and return, along the way, and return that cash flow to its investors, it may not be a bad investment.
Right.
You said, so I guess I'm very impressed. A lot of people that were around back then, especially in their formative years, and maybe it wasn't formative for you, although sort of earlier in your career, they got stuck.
When I was younger, as you pointed out.
When you were younger.
Before I got old, is what you said.
But a lot of these people got stuck and said, like, I've seen this movie before. We know how this ends. We know that value and small value and whatever will have its day. And you have to evolve with the times. These businesses are fundamentally different. The operating margins, which was one of the big points in 2015, is like, these are unsustainable. Competition comes in. You wrote in 2015, buying a company at 20 times earnings, hoping for growth in earnings and a future P of 22 times, is not a recipe for good risk-adjusted returns. Kind of is now, a little bit.
For the time being, yeah. And
by
the way,
things change.
Things change.
And you've evolved, obviously.
Yeah.
But is that one of the hardest parts, is to throw things away that maybe you believe in, but you recognize that if the rest of the world doesn't believe in something and never will again, it might not be important anymore. It's one of the things that I've learned.
And we're also, buying a business, when we buy something, we want to have a clear view as to what the future looks like. What we want to have a clear view. Doesn't mean it's going to unfold that way. I guarantee you it won't. It'll unfold differently. And so we always lay out what our KPIs, our key performance indicators are, to watch and monitor that business along the way, because we're going to be wrong. One of the biggest mistakes we made was not buying Amazon earlier on, at least in the financial crisis. We didn't buy it.
Everyone's biggest mistake.
Right. And not everyone's. A lot of people out there don't made a ton of money, but sadly it was one of ours. And so, I read the Everything Store book. And after I read that, I'm like, I was so sad, because I didn't spend the time really enough on the web hosting business and what they were doing. And I spent
AWS.
Yeah. And I also was less willing back then to pay for, I'm so concerned about the here and now and what was obvious about the future, as opposed to like, they can always change pricing and charge more money for X or Y to create greater profitability in the future. I was less willing to do that. But it really depends on the management team and what they're communicating that they're likely to do.
It makes you feel any better. That was the biggest miss, according to Warren and Charlie. That was their biggest miss. They knew it was going to work, and they just couldn't bring themselves to do it because it looked so different from every other retailer they had ever invested money in. So
misery indeed loves company.
You're a good company. Can we talk about the modern market, today's market?
Yeah.
Okay. Dying to get your thoughts on this. Michael, you have a couple of charts that are worth scrolling through just to set the table.
So we are in a period of time where not everything, a lot of things are working really well. And it's the things that you want to see working. And there's, of course, a lot of bullshit. But for the most part, the market is acting very well. So we've got the NASDAQ 100 has closed above its 50-day moving average for 102 straight days. And there have been longer periods of time where it's done this, but they're few and far between. You've got the NASDAQ 100, as I just mentioned, the S&P, as well as the Dow, and the Russell 2000, all making all-time highs. And you're seeing it in the sectors, the leadership sectors, financials, tech, communication services, and then you're seeing it in terms of the equal weight tech versus equal weight S&P. It's everywhere, and it's not just in price. It is being driven, thank God, by fundamentals. So when you're looking at earnings estimates for the S&P, for the NASDAQ, as well as the Dow, all up and to the right, You're seeing everything you want to see. I guess the question that Josh and I were talking about earlier
Let's
in the
put
week
up
is...
the equal weight tech really quickly.
We did that.
We got that one?
Is the market too good right now? Does it feel too easy?
And do you automatically get concerned when Michael shows you charts, everything at an all-time high, like every major index, or not necessarily?
No, that's my DNA.
Okay.
Is to get concerned, but that doesn't mean there aren't opportunities.
Of course.
So when you look back, we look back, and let me just start with making analogous to the internet bubbles. We were talking about the .com, bust back in 2000. And when you look back then, 25% on a capitalization weighted basis, 25% of the S&P was trading at greater than 10 times sales. Today, it's 35%. So yeah, that raises our hackles, and we get concerned. That doesn't mean there aren't opportunities out there. We, despite, those nice charts you say upward to the right, there are companies that are less important to those indices. They're smaller cap that are trading less expensively, both domestically and abroad.
Yes.
So we have a large component, about 40%, of companies domiciled outside the United States. We also have a number of companies that are more cyclical, and those companies are less interesting to the masses and are not hitting new highs. We've got certain healthcare related companies, not to dive into specific names, and healthcare is too broad a term. That we're finding, as opportunities. But a lot of these companies, along with those small and mid-cap companies, are just, trading below the radar. But what's interesting is there is this table I'll send you guys, and that really shows over from the October 22nd market low, how have things done through June 30. And large cap growth has appreciated 108%. Large cap value is only at 51%. But to help make my point, small cap growth is up a lot less than large cap growth at just 41%, but it's also up less than large cap value. So there is more opportunity. Now, look, again, we're talking at an index level, and they're comprised of lots of different types of companies. Doesn't mean every company's cheap, obviously.
Do you need a catalyst, though, when you're buying, let's say, a healthcare company that has sat out this entire rally? Let's say it's selling at a huge discount to the overall market's multiple. Is the fact that it's cheap and that the business is a good business, is that enough for you? Yeah. Or do you also want to know why it might someday attract the attention of other investors who will buy it higher?
If you have the right management team allocating capital well, good things happen to cheap stocks. Okay.
So you believe it's not important why it will go up. It's just important that this business is throwing off a lot of cash flow. It's defense. It's got some moat. And we think this is going to be a good business for the next few years. Therefore, it's a good investment. And someday someone else will agree with us and buy it higher.
We do think about what catalyzes it. It's not like we don't think about it. We do. We just don't always have an answer.
Okay.
I mean, if you think about our position sizing, this kind of gets into that. The greater conviction you have in the company, this business, and its mode, and its growth rate, and its management team to allocate capital well and understand what the catalyst might be in the future. All of those things, you check the boxes, come back rosy, then you end up with a larger position.
I'm sure when you look back over your career, you think about how nonlinear businesses are in terms of the path that they travel, ups and downs. Like Netflix has had a million different hiccups along the way. So how important is getting the industry group right versus getting the winners and the business? Like we're talking about fundamentals and value investing and, ratios, but like these, at the end of the day, you have to be a business analyst.
Right. 100%. I mean, I'm more partial to the idea of having tailwinds. I don't mean like gale force tailwinds to push my America's Cup yacht, across the finish line. I just mean that the fact that why do I want to buy a business all else equal where it's deteriorating?
And will fighting a prevailing trend. That's
and then sometimes along the way, it's like, will a company that's fighting that prevailing trend, to use your phraseology, is some companies will fight it successfully, the others won't. Why has Walmart been successful and Target successful, but Sears not?
Yeah.
Right. So we just, we're always mindful about what the management teams are doing. It's not, when you analyze the business, you got to understand the management.
So this is a business that's in secular decline, a stock that I tried to bottom fish and I didn't, I sold it. Western Union, for example, if you were to just look at the fundamentals, just like the strip away the business, they pay their dividend every year. I don't think they've ever cut or not paid, at least in a long time. It's a 10% yield. It's cheap, but obviously it is being disrupted. It is under a massive amount of pressure. Not specific to that, but a company like that reinventing itself. Is that interesting to you?
I don't know Western Union well enough, but just, and this might be way off base, but superficially what I know of Western Union in terms of, delivering money from point A to point B, and, somebody here who might be a migrant worker sending it back to their home, in a province in Mexico, is a way, to, get money back to them and help their families. You can Venmo. I mean, the digital banking system's there. So I don't see
stable coins.
Again, I don't know what
Venmo,
else. I don't know what else there is.
Yeah.
Out there in their Western Union business, again, as I haven't studied it, but if it's just, that's what it is, doesn't hold any interest for me to even want to look at.
One of the things I wanted to ask you about was just this idea that there are some value investors who will, they don't last long, their careers don't last long, but there are some value investors who will become personally invested, almost like a defiance, like I'm not wrong, the market is wrong, you'll see. And I saw people ride Sears to zero. And I'm sure you did too. And
Kodak,
JCPenney.
million of them.
And look, number one, I'll just stipulate, it's really hard to know when doubling down, like sometimes it might actually work out well. And then you have the coal industry where every company in the industry goes to zero. The steel industry, I think we were left with one and now Japan owns it. We've seen entire industries disappear. So how do you guard against making that type of error where everything you believe might be true and yet that prevailing wind that's in your face, it never goes away until these companies just entirely disappear?
Well, again, sometimes what's inexpensive is there because of, ephemeral headwinds. So it's our job as analysts, business analysts, to your point, to understand what is ephemeral. Is that going to change if this is just a cyclical business, or is there something that's secular that's happening negative? Now, we might get it wrong. And there was an example. We didn't buy Amazon, but we did sell our entire portfolio of retail stocks. Last one standing was Walmart, and then we sold that. And then we bought back, because we had owned it previously, we bought back PetSmart. And for a minute, just a starting position, and then we ended up selling it quickly because we realized we were wrong. So you have to have the intellectual integrity to question yourself.
Yeah.
You just can't rest your laurels, and defiance doesn't get you anywhere.
One of the problems and one of the origins of that defiance is when you go out publicly and you quote defend the stock, or you plant your flag, or I know you don't do this stuff. You go on Twitter and you say, this stock that I just bought at 20 that now is 10, I'll bet my life it's going to make a comeback, because people don't like to be publicly wrong. So maybe not talking about your biggest positions in such a public way, or putting your life on the line for a stock, is like a really great way to avoid that issue.
And it's also like what your DNA is and how willing are you to admit you're wrong. And, a lot of that's just formed by your DNA, and some of it's formed by your environment. I live with 5 women, my wife and 4 daughters, and they regularly tell me I'm wrong.
Wife guy. I told you. I knew it. I was right.
I didn't say I was.
Right. Just kidding. So in the context of your life, you're somebody that's comfortable being wrong.
100%.
And then not putting yourself in position where you have to defend something to the death.
We'll take our mea culpas. We'll say we were wrong and why we were wrong.
That's, you know what? People get really attracted to high conviction type of people who come out and say the 10-year is going to 6% and you're going to wish you listened to me. That stuff gets a lot of attention in the short term. You can't survive 20 years doing that, because you're going to be wrong. And you have to have positions that you're comfortable backing off on publicly. So
look, the world can change. The world does change. Companies can change, as you pointed out. I think it was Michael who said it, and you have to be on top of that. So if you go out there and speak with great conviction about a certain company, then you're going to come out and after you've sold it and say, okay, here's why we sold it. It's just too much noise. We don't want to be in that business.
Yeah, we
want the number. The first slide that you showed,
yeah,
shows upward to the right. We want that to be our slide over the next 20, 30 years.
Right. We get things right. We get things wrong. But the sum total of all of that effort is this.
Right. And our portfolio moves in and out of different asset classes and different sectors based upon where that fear is. And so our energy exposure was a lot higher, in the early part of that shows our whole
Okay, so the blue is
exposure.
stocks.
The blue is stock. You see that moves around. The green is bonds, and the bonds that we own are not high grade. We'd rather accept credit risk rather than interest rate risk. We think we can understand that better.
Interesting.
We don't know what direction the 10-year is going over the next 5 years.
And you're not, when you do that. So like I see these periods of time where you're heavily invested in bonds. You're not just flipping it into HYG. Like you're actually looking at each individual credit.
Yeah.
Okay.
Yeah. Our high yield exposure today is just 1%. A little less. And that 1% is high yield isn't that interesting today. Today we're talking about tighter than average spreads, lower than average yields, and worse than average covenants.
Yeah, sounds great.
High yield spreads are 300 basis points, over treasuries. It's 200 basis points less than the 500 basis point, average over the last, 20 years. The yield is 7.1%, which is about a point less than the average over the last 20 years. And covenants, as I said, as poor as they've ever been. So much and so in favor of the borrower that you don't even have, the confidence you can get the keys to the kingdom back in the event of default. Now, on the positive side, I'm looking at the HYG, for example. I think, I've read that I haven't parsed it, individually myself, but I've read, something about it that suggests that the HYG, the high yield index, has more EBITDA per average company in there than at any point in time
It's
previously.
higher quality than it's
higher
ever been.
quality businesses with
All right,
less.
so lower spreads makes sense.
Right. So yeah, but a lot of that risk is shifted over to the private credit market.
Right.
What is this net risk exposure, this red line?
Well, because we end up with some shorts at periods of time.
Okay.
So like if you go look into the financial crisis.
So you'll have shorts in the portfolio.
Mm-hmm.
Is there a max? Is there a max limit?
Well, not a max limit. I think I'm not sure if there's actually a max limit in our charter. We've just never approached it. I think the most we've ever had was like 11%.
I'm seeing some shorts.
A little bit.
I'm seeing a few.
I'm not going to talk about them.
You want to wait for a better pitch. You have the ability to go into different areas of the market, de-risk, up-risk. But the pitches seem to be happening so much faster these days. It's like they're 175 miles an hour.
Yeah.
When you finally have a chance to swing, it's like, what just happened? And I'm talking about the
really
V bottoms.
A great point. No, really a great point. You have to be prepared in advance for when it does happen, because the world has had a tendency, since the financial crisis, to rebound very, very quickly.
Everything's faster now. Why wouldn't the market react faster?
I'm not faster. I'm 62. I'm much slower.
But every aspect of our life has gotten faster. So why wouldn't we expect stock market reactions to be faster?
There will be a point in time, I would argue, that things will go down and stay down for a period. I just don't know.
22, they did for 22 for 18 months.
Yeah, but I don't know when that's going to be, or what next is going to happen. That's going to create that opportunity. But we have to do the work first. You just have to be ready to go and hit those pitches. Because they're coming at a point. And so, for example, I did a ton of work on. Embarrassingly, given that we have nothing to show for it, on Deere. Because I said that pitch when that comes, because I did this about 1.5 years ago. And I said Deere is the best ag equipment manufacturer in the world. Case New Holland and AGCO pale by comparison. And earnings are going to be down because the ag complex is up in value so much. Commodity prices are up so much. And, when farmers are making more money, they buy more equipment. And so business is good. So business is going to be bad again in the future. It's a cyclical business still. And so we'll be able to buy it. Stock hit a new high.
Yeah.
And so it's like, work was for nothing. So again, being prepared. But this idea.
Well, Deere turned the tractors into iPhones that have to update software, and everyone's got to pay monthly. And they made it the best business in the world.
It's the technology. They lead in technology by far. Yeah. It's pretty great business. But across the firm, we have this sensitivity to losing money and trying to be prepared. That's why our fixed income team, led by Abhi Patwardhan, is one of the reasons why it's done as well as it has as well.
Oh wow! I noticed there's no gold in that allocation, but can you go there if you feel like it?
Yeah, I just don't feel that people are paying us to make a gold decision, because if you were to go and buy gold, and you're going to have 5%, and you'll see people have it, or even 10%. If gold were to, double from here,
yeah,
what does that mean about the rest of the market? What have you really done for your portfolio? And I just don't know that we're adding the value on our team that offers some kind of variant view to it. That does not suggest for a moment that gold isn't worthwhile owning. I'm not saying that.
Well, Eviard did that. So First Eagle Global famously would combine stocks, bonds, and gold.
Mm-hmm. But even then, his gold position, how big did it get at its peak?
Well, probably the gold miner position was the proxy for gold in that case, maybe.
Yeah, so I just don't. I'm including gold miners, junior gold miners, gold ETFs, or even just owning the bullion, all in the same bucket.
I want to put up a couple of your slides, John. Can I have chart 13, please? This is from your deck. Fund objective met since inception. So congratulations. But walk us through these three different charts and why these are the ones that you want investors to pay attention to when they look at your fund.
Yeah, we have to show this one from inception because it shows the S&P 500, but the MSCI ACWI has been our benchmark since 2011.
Global stocks.
And you definitely beat that, right?
Yeah, we've beaten that. And so as international is not done as well as the US, it helps explain why our equity-like rates of return are like 40 basis points, behind, the S&P 500 in part. But we've done that with averaging 30% or so in cash along the way. So
it's really incredible.
A lot less risk.
When I look at this, I say this is incredible.
Yeah. Our goal is to deliver equity rates of return and avoid permanent impairments of capital. Permanent impairment of capital means losing money, monetizing, realizing that loss rather. And whereas, volatility is just, things are going up and down. And so you can look at the drawdown, and the drawdown's, half of the markets.
Well, so for the people that aren't watching or listening, I want to say this out loud, okay? Since annualized total return since inception, and guys, picture every disclaimer you've ever read in your life, okay? That's what's on the bottom of the slide, okay? You guys are neck and neck with the S&P at 10% and change. But then the largest drawdown in the S&P 500 since the inception of your fund, as we all know, is 55.25%, which I'm guessing that's Great Financial Crisis?
Yeah.
Okay. And your largest drawdown is 27.87%. So that's the objective of the fund. The reason you're going anywhere is because sometimes you don't want to be fully invested in the stock market.
Right.
Okay.
And a third less volatility. It's like
but that's a byproduct. I want to be very clear. A third less volatility, and just speaking, for what the chart shows for those of you who can't see it, our volatility has been 10.89. The S&P 500 is 14.96 since our inception. But volatility is a byproduct of our process. We don't target.
What is that, rolling 30-day? What is the volatility? Or is that just standard deviation?
The standard deviation.
Okay, fine.
That's it. Standard deviation. But we don't target it. It just, if you're a value investor, if you're thoughtful about if you believe price matters, you're thoughtful about the businesses you own, and you're seeking to protect capital, you're inherently going to have lower volatility.
The mutual fund industry, there's been a million slides showing index flows up and to the right, mutual fund flows going the exact opposite direction. And a lot of that is, listen, even the ones that do outperform, luck versus skill, how do you untangle all of that? This is evidence that this is skill, because being able to keep track with the S&P with a third less volatility, that's not luck. You've done this for 3 decades. So pat yourself on the back. Pretty good.
John, can we have chart 15, please? I found this one interesting. This is the FPA Crescent Fund's net equity exposure.
Whoa. Why are you so bearish?
Stop. So this is you versus the MSCI ACWI. What's the right way to explain this? Like the percentage of your portfolio that's currently in equities on a net basis,
right?
Versus the performance of the index itself, the ACWI in this case.
And this look, there's a lot of noise in this chart.
But you're trending lower since 2022.
Right.
That's like if I were to draw a trend line, you are growing increasingly bearish as the market rallies.
Well, bearish presupposes bearish presupposes a view to the future. We're just not seeing in the present the attractive risk rewards.
So what if I also drew a line that said forward earnings multiple? Like it would probably
that would be a better chart than this, because this just shows.
This is your slide.
I know. We have other slides too. You just picked this one.
Okay.
We've got lots of slides.
Right.
But this just shows you this slide. Like one can expect that as the markets are rising, that especially rising quickly, because you can see that dip as it rises, that we are going to get more exposed or less exposed as the market rises and get more exposed as it declines. So you can see, look at Q1 25. So we had pulled our
56% net equity exposure.
Right. But then Liberation Day happens. We found out more opportunities, as a result of our president's actions.
Pitch came.
Yeah. And so then we started getting more invested. But unfortunately, it gave us only a couple of days, again, to your point about the 175 mile an hour fastball you got to hit.
I would assume that you're surprised, again, having read your 2015 letter this morning, because I'm surprised that we're 10 years later. And at the time, it's not like things felt cheap or exciting at the time. Amazon was $200 billion. And I remember thinking, holy shit, that's a lot of money. Like a $200 billion market cap. Oh my God. And it's 10 years later. And of course, there's been pullbacks and corrections and bear markets along the way. But these businesses have never been fundamentally stronger. Is it conceivable that this is just a sort of,
he wants you to say it's different this time.
No. Obviously, it was different this time. I mean, clearly it was.
Yeah.
Well, some companies are going to last longer than others and perform better for longer periods. I mean, you mentioned, or at the top of the hour, you were talking about Cisco. Cisco has far underperformed Microsoft, but did we actually know that was going to be the case?
Of course not.
In February of 2000 when the market was peaking? So look, we have a portfolio of stocks. Some we're going to be, more right on than others. And we're going to be surprised on the upside and the downside by different companies in our portfolio.
So you're very much focused bottom up, looking at these securities themselves. How much do you think about the state of the economy and macro stuff? Like, does that enter into the process sort of like working backwards because the companies are talking about these things? Or do you pay attention to these things from a top-down perspective at all?
When we look at companies, we build models. And there's this false precision to the models. I mean, because you plug in certain assumptions and you end up with this very precise, earnings per share, result, or precise, free cash flow result. And the truth of the matter is that it's just a function of our assumptions, and we're not anchored to that type of precision. When we build our models, we don't look to see what is likely to happen over the next, quarter, 6 months, year. We build a low base high, looking out over the next 2-3 years or longer, to try and say, okay, what can happen, if the company really executes, and recognizing that they could stumble and maybe not execute. That would be the low case. Maybe the industry goes through a downturn that could contribute to the low case, and in the high case, everything happens, terrifically, And so that's how we really think about the macro backdrop. That's all set against the macro backdrop. What could happen in a weaker economy? What happens if rates rise? If it's a more levered company, they have to refinance their debt at a higher level. Right. What happens in the event of a recession and unit volume, gets hurt? What happens as a result of tariffs, where a company has to either raise their prices in order to maintain margins, or do they not maintain their margins because they're going to, basically eat it for their customer to make sure the unit volume stays there. Those are all the questions we're always trying to anticipate up front when we build our models. And then we constantly fine tune them as we gather new information.
So this is on a case by case basis, each investment, not I think the Fed's going to cut next week, therefore we should own 10% more financial stock. Like, that's not the way that you're thinking about the macro picture.
Correct.
Okay.
So one of the things that traditional value investors that are not bottom up have gotten wrong over the last decade has been things like the CAPE ratio and margins and their mean reverting nature. That they never mean reverted, and a lot of the reason is because the index is primarily at this point the large tech companies. Their margins have a much different profile than the 493. As you look out with your portfolio, do you expect to see margin expansion as a result of this hopefully productivity wave that we see coming as a result of the AI spend? Do you think that's going to happen?
No, I think that it depends on the industry. So I don't want to make a too broad a statement, about that. So the AI, a lot of there's a large language models and the big AI that's out there. How that unfolds and who's the winner from that and what the margins will be, I just don't have a point of view. The applied AI and how it's used to help your business, and whether it's to distill, the SEC filings and look for certain things and to be able to pull from it, using Grammarly for me to help write my shareholder letters so I don't look completely moronic, making, basic grammar mistakes. Then there's also AI that's going to be used in certain businesses that will really help these businesses, and it's not going to get competed away. Companies like biotech companies, which we don't have any expertise in, to be fair, but the bench strength in the labs because of AI is up exponentially. And that's good. That's good for the world. You can deliver, hopefully over time, we expect, drugs are going to come more frequently, new drugs at lower costs. And that shouldn't get competed away. What could happen, of course, is on a regulatory basis, you could end up with less margin allowed for these drug companies because there's more margin allowed in the U.S. than elsewhere. So there's other risks to it. But some companies that are benefiting from AI, a lot of it, some companies will have first mover advantage, and they'll be able to reduce their cost And then let's just take let's look back in the 1970s and some of these vertically integrated apparel manufacturers with retail locations, and they moved offshore their manufacturing. So they were able to manufacture at a much, much lower price point, bring it, even despite the long lead time, with therefore a higher financing cost, as well as they have to pay to ship it to get to the United States. But they were able to bring it back and have this big pricing umbrella because their competitors didn't have that. So they had this excess margin. Well, all the other guys realized that and said, oh, well, I'm going to go overseas and do that. And that got competed away. So you're going to see some of that happen too.
Yeah, I've heard from a lot of people, you ask like, all right, it's the AI era. Why would you be bullish on small caps? Why would you be bullish on healthcare? And all of these areas that have either nothing to do with the AI boom or are so disconnected that it's almost like we're having two different conversations. But I've always thought, and I've heard this from a lot of people, if the AI boom is not going to turn into a bust, the only way that happens is if all these other companies find a ton of value in using these tools and adopt them and pay for them. Otherwise, AI, in other words, if you don't get an earnings growth benefit in the rest of the stock market, then by definition, all of this CapEx spending by the mega caps is going to look wasteful in hindsight.
Well, no,
it has to work.
You're going to have to. Well, first off, some AI companies are going to be incredibly successful.
Yeah.
Some aren't. Which ones will those be? It's for a different conversation.
We'll all find out together.
Exactly. and but I mean, look, there's no question that AI is a real benefit for IT services, for calling a tech support line, or calling for a retailer if you want to return something. You could end up with these questions for a return that can all be handled by AI. So a lot of these phone centers that are located in other parts of the world and that have a very, very low cost labor pool, are going to be disintermediated because of that. Yeah. And everybody's going to migrate in that direction.
Right. So I sort of feel like the secondary benefit of the AI boom has not been felt yet. And all of a sudden, there are a lot of companies that are going to come out and start raising their earnings estimates. And the reason why is going to be productivity.
To the extent that isn't competed away, which would be business and industry specific. Some cases it will be.
That's a really great point. I wanted to ask you, with the 2 or 3 hours we have remaining, I wanted to ask you a couple of other hot button items that are going on in the markets right now. The independence of the Fed, and just generally what you think of monetary policy given the unemployment rate versus inflation push-pull. You think that's something that is going to be very impactful on the markets, or not really, or to be determined?
Well, I mean, TBD. It's not something I really can opine on. I have no idea.
Okay.
I do. I mean, we do have a Fed chair that has come out and said that security prices are rich. So
yeah, I don't know why he had to do that.
Well, by the way, I mean, you had Greenspan in '96 who called for irrational exuberance, and then when he got the S&P 500 price level, even after the decline, in the dot-com bust, it was still higher than when he called it. You had Bernanke who said that in 2007 that the subprime crisis would not spread to the broader economy.
Oops.
And Yellen said in 21 that the inflation would be transitory. She admitted her mistake in that regard. So I mean, you just
Okay. You don't worry so much about the public pronouncements.
We are really good at responding to pitches that are thrown to us, but what you're basically asking is what pitch is going to be thrown to us. We don't have any idea.
Quarterly earnings reports versus, I don't know, annual. How important will this be to your process if all of a sudden 300 of the S&P 500 decide, oh, this is cool, we'll talk to you every January?
Look, first they're talking about semi-annual and using the European model.
The UK way.
They'll talk to us twice a year, but they'll talk to us along the way. They just won't give us numbers in between. They'll talk to us along the way. Actually, they might be able to talk to us more because there'll be less quiet periods. So I'm completely in favor of it because
you like it.
Businesses don't generally change much from quarter to quarter. I've already laid out that we are looking longer term anyway. So I'd be fine with annual reporting. Maybe it separates the renters from the owners, and it look at these companies. It lowers the reporting costs for these companies. It frees up the management time to focus on what's important.
Does it potentially lead to increased volatility because there's a higher potential for surprises, and some of those will be negative?
I don't know that that's necessarily the case. I don't think if you look at the vol of the UK market versus, I'd have to go back and
It's
look.
the same.
But
you're not investing in disruptors. So
well, at times we are, and we own some of them. We've owned some of them over time. I mean, Netflix was a disruptor, right, or is, as far as remember Hollywood Pictures and Blockbuster Video and Movie Gallery. We we're short.
I think I owned Blockbuster at one point.
Yeah, I didn't.
Yeah.
I mean, I was short. We were short Hollywood Pictures and Movie Gallery.
24/7 stock market trading.
God, I hope not.
Well, it's inevitable. So
I know. I like to sleep at night.
I don't like it either. I don't like it because it's like money's on the line that we're ostensibly responsible for, and we're sleeping. So I don't love it.
Yeah, except for the fact that the news won't be coming out in the middle of the night. So that's really going to be the bigger driver. It's going to be, at the end of the day, it's going to be noise, right? I mean, if your assumptions are correct and you look out into the future and you've got that longer term point of view, yeah, you can have more volatility along the way. But all we care about is some price. I say this as if I'm, sleep well, which I don't. Is the day you buy something, the day you sell something.
Did you have trouble seeing the entire asset management industry make this really hard pivot into digital assets, considering that outside of staking, the majority of all of this activity, there's really no cash flow generation, very difficult to value these things. They're mainly a function of supply demand, making them look more like commodities or currencies than they look like stocks. Like, did you have trouble watching that play out?
Give me an example of what you're talking about.
Bitcoin, Ethereum.
Yeah, so in terms of the digital, so I think that cryptocurrencies, are real, right? But we don't own them because, well, at least speaking for myself and not my partners, I just don't know how to value them. Is Bitcoin worth 112,000? Is it worth 50,000? Is it worth 20,000? I just don't know how to value it. And if I can't ascribe a value to something and be able to articulate why I believe that's the value, I won't own it.
What if somebody says the way to figure out the value is the network effect, because effectively these are technologies, and so the more users, the more highly they should be valued, or the more
that's just direction. That's not value. That's just the direction of the value. That's not giving me a benchmark.
Okay. I wanted
and then what happens when quantum becomes a thing, and you can bust the RSA algorithms ostensibly at 1 million qubits. So that happens. What happens to your digital wallet?
There's going to be so many Lamborghinis for sale on the secondary market the day somebody comes out and says my quantum computing has just solved all these equations at once. Has anybody ever, or how many times I should say, or how frequently do you get people asking you why you don't have an active ETF version of your extremely popular mutual fund?
Well, we have an active ETF subset of our fund, right? The son of. So we have, our FPA Global, symbols FPAG.
Okay.
And that is our larger capitalization companies that we're not worried about scaling. So if you have an ETF,
can that go anywhere, or that's just the stocks?
It's just stocks. It's delivered programmatically from our larger companies that we own. It doesn't own the debt, doesn't own these smaller companies, doesn't own any derivatives.
So no liquidity problems.
Right. So you don't have to worry. I mean, one of the problems with ETFs is they can become too big. So how do you do that with small cap? So we want to be always true to our investors. So this is something we can look at our investors with a straight face and say, look, if you want a more fully invested version of what we do, for the large cap carve out of what we do, then here we hand you FPAG, run by my partners Brian Selmo and Mark Landecker.
Are you just generally speaking, are you hopeful for the investor class over the coming years? Not there won't be a bear market or there won't be a correction, but just generally speaking, think
I'm actually more hopeful because with these pod shops and all the trend towards passive, I think it gives people like us, a greater potential opportunity. So I'm actually more excited today than I was 10 years ago.
I love
Valuation notwithstanding in the market at the moment. That can just be temporary.
I love that. Thank you so much. This is the man, right?
The man.
All right, we're gonna break for dinner and then we'll come back and we'll do. You good? You think we got it all?
Yeah.
All right. Dude,
can we just eat dinner right here? Let's bring it in.
This has been so awesome for us. Michael and I are obviously fans of what you do, and your track record speaks for itself. But also, I think anyone that reads any of your stuff learns something every time. So thank you so much for that. Really appreciate it. We always end the show by asking people what they are most looking forward to or what's something they have coming up out on the horizon that they're excited about?
Why is there applause?
That was very weird. That was a preemptive applause.
The audience is
very actively
anticipating
engaged,
this
fake
with
audience.
great fervor.
Professionally, I look forward to the next cycle to put capital to work. I mean, I look forward to that dip, buying, something that's significant.
Well, it'll be 10 minutes long. Are you going to be ready?
Well, we'll see. We'll tell you after the fact. And then, personally, I just kind of hope I have grandkids one day, but I'll need some son-in-laws for my daughters first.
Steve. All right, dude, you're the man. Thank you so much for being here. We really appreciate it. I want to say to all the pounders out there listening, thank you guys so much for watching, leaving us ratings, leaving us reviews. We really appreciate it. Guys, great job this week. We're good? Yes? All right. Thanks so much. We'll talk to you soon.